What are inflation-indexed bonds? An inflation-indexed bond, like a traditional bond, pays out interest at preset intervals and returns the original investment once the bond matures. Unlike a conventional bond, however, an inflation-indexed bond links its cash flow to actual inflation levels so that the real rate of return matches the nominal interest rate of the bond. In this way, both investors and issuers forego the risks of fluctuating inflation levels in the future. Many industrialized countries such as the United Kingdom and France offer inflation-indexed bonds to pay for their debt. Inflation poses a greater threat through gradual erosion of the principal for a long-term bond as opposed to a short-term investment, making inflation-indexed bonds an attractive option in inflationary times for long-term investment. For example, a 10-year $100 US conventional bond with a nominal 3% return and a predicted 3% inflation pays a real rate of 7%. If the actual inflation level reaches 5%, the investor will receive only 2% per year on his investment. Moreover, he loses money if the inflation rate doubles to 8%. With an inflation-indexed bond, on the other hand, the real return rate adjusts to 8% to assure the nominal return rate of 3%. Even with 8% inflation, the inflation-linked bond guarantees the 3% rate of return. The United States Treasury issues notes or bonds called Treasury inflation-protected securities. With a TIPS bond, the principal itself is regularly adjusted to protect it from inflation-related erosion. For example, the principal of a U.S. TIPS bond of $10 with a nominal return of 4% and an annual inflation rate of 3% will be adjusted at the first semi-annual payment date to $10.150 with the upward adjustments of half of the annual inflation percentage. The interest will then be 4% of the inflation-adjusted principal, $406. Furthermore, the principal never falls below the face value even if the inflation-adjusted principal theoretically dips below the original investment. Inflation-indexed bonds provide benefits to sovereign countries as well. With traditional bonds, issuers pay higher amounts of interest than they expect to pay when inflation levels drop below the predicted level. For example, a 3% nominal bond with predicted 4% inflation pays a fixed real rate of 7%. If inflation runs at an actual level of 2%, the issuer pays 2% more than he would otherwise have to pay to maintain the nominal return. When governments offer inflation-indexed bonds, the real rate always equals the nominal rate. Investors generally accept lower stated rates for inflation-indexed bonds than for conventional bonds in exchange for elimination of the inflation risk. Interest rates in the economy consequently remain low. Low interest rates stimulate investment, research, development, and consumer spending. They also reduce the cost of servicing the federal debt.